Hey, what is up, guys? It's Emil Ayoub, your realtor here in sunny San Diego. First off, just want to mention I'm giving you a special free gift. I'll let you know how to get it a little later on in this video. So if you haven't heard, interest rates are going up. They've actually been on the rise for a while now, and they will continue to go up. March 21st, the Federal Reserve raised the federal funds rate by 0.25%. This is the sixth time they've done it since the financial crisis in 2008, and they're expected to do 2 more rate hikes this year in 2018 and 3 more rate hikes next year. Now, this is actually good news because it means that the economy is getting stronger. And historically, higher interest rates is very normal and indicate a healthy economy. Obviously, it's not good news for buyers who don't take action now. For everyone else, it's good news. To start, I want to clarify, what is the federal funds rate? It's actually not the same thing as mortgage interest rates, which a lot of people think. What it is the rate that banks charge each other for overnight loans so they can meet their reserve requirements. So does it affect mortgage rates? Kind of. So they're not directly tied to one another. However, over time, as short-term interest rates go up, long-term interest rates typically also increase, which affects the rate of 10-year treasury bonds, which influences mortgage interest rates. Super fun stuff, right? So basically, movement in the Fed funds rate creates a sort of ripple effect, which does indirectly affect mortgage interest rates. Hope that makes sense. So what does that mean? Well, if you're one of those people that's thinking about doing something, that's been sitting on the fence, waiting for the perfect moment, now is the time to do it. Now, I'm not trying to make you buy or sell if you don't want to, but if you are thinking of doing something, you should know that rising interest rates will affect that. And you might be surprised at how much a change in interest rate actually affects how much you pay the bank in interest and how much you qualify for. So I created a nifty tool that I'm giving you to help illustrate. So let's take a quick look. All right, so this is my shocking rate comparison tool that I've created and I'm giving to you for free. So here's how it works. First, let's assume that you're purchasing a property at $700,000, which is close to the average sales price here in San Diego, and you're putting 20% down. That gives you a loan amount of $560. With loan scenario number 1, let's say it's a 4.5% interest rate. Here is your monthly mortgage payment, $2,837. Now, you can see that if your interest rate were to increase, let's say to 5.5%, your monthly payment would increase to $3,179. That's a difference of $342 per month more that you're paying. So let's say if you were to keep the home for the entire 30-year life of the loan, you would end up paying over $123,000 extra in interest. That's extra. And it gets worse than that because not only is your payment going to be higher and the amount of interest you pay higher, but also the portion of your payment that goes towards paying down the principal balance is going to be lower. So let's take a quick look at the amortization schedules here, and I want to give you a fair warning. Most of your eyes may gloss over seeing all these numbers, so you don't need to pay attention to all of this, just right here. So with loan 1, 4.5%, your first payment of $2,837 has $737 going to pay down your loan. The other $2,100 is interest. So if we look at loan number 2 with 5.5% interest, your first payment of $3,179 has only $612 going towards paying down the principal balance. So that's $125 less that's going towards paying down your loan, even though you're paying $342 more per month. So where does all that difference go? It goes towards interest. So let's go back to the calculator and let's say that you decide to sell the property after 5 years, which isn't uncommon. With loan 1 at 4.5%, your remaining loan balance at the end of year 5 would be about $510,000. That's how much you need to pay the bank back when you sell. With loan number 2, that number would be about $517,000. It's over $7,000 more. So with the higher rate, if you sell after 5 years, you owe the bank an extra $7,000. Plus, look at this, you've paid them nearly $28,000 extra in interest over just that 5-year period. That is pretty shocking, am I right? Now, this example was with the purchase price and the loan amount remaining the same. Well, let's say the $2,800 payment in scenario 1 is the max you qualify for based on your income, or maybe that's just the max that you want. So that means when the interest rate increases, you won't qualify for the same loan amount anymore because the interest rate's higher. So to stay at the same payment amount with the new interest rate, you now only qualify for $499,000. So using the same $140,000 down payment as before, that means you can only buy a $640,000 home rather than the $700,000 you could have bought before. So you've lost over $60,000 in buying power. That means even though you're getting the same payment as before, you have to settle for a home that's worth $60,000 less than before because the interest rate is now higher. Crazy, crazy stuff. So if you'd like to get this tool for free to play around with yourself, and all the equations are built in, so you just plug in what numbers you want in only the yellow cells here. So if you could say $400,000 purchase price, or change the down payment or the interest rates, you can make that 6. Everything auto calculates. So just simply go to the link in the description, get on my VIP insider list, and I'll send you this tool for free, and you'll also get some other really cool tools that I'll be creating in the future. So hopefully if you're a buyer, you realize how humongous an effect interest rate has on how much you pay and can afford. So my advice is, don't snooze. You snooze, you lose. Right now is the time to take action. If you don't use the low interest rates now, you're going to lose it. And as interest rates rise, your buying power drops dramatically. For sellers, it's time to jump on it. This could be the best time to sell your house because as interest rates are going up, buyers get more motivated for multiple reasons. They still see price going up. They see interest rates are going up and they know that their buying power is going down. So they get motivated to take action faster, which is still putting an upward pressure on price. After interest rates reach a certain point, it will start to put a downward pressure on price because when interest rates are higher, the amount buyers qualify for decreases. Now, I'm not a psychic, unfortunately. Otherwise, I would be very rich from buying Bitcoin back in 2009, right? So I'm not predicting or projecting what will happen. I'm simply saying that this is what is happening now, and you should use this information to your advantage. Hope this was helpful to you. If you know anyone thinking of buying or selling, this information could be worth thousands of dollars to them. So be a good friend and share this video with them or tag them in the comments. And if you have any questions or there's any way that I can help, feel free to send me a private message, or you can call or text me at 619-339-3645. Until next time, this is Emil Ayoub in San Diego. They're not directly tied to one another.